Hi guys, this is Nick from Surge Traders, and today I'm going to show you guys how to use the MACD. So when using the MACD, there's a couple things that you can notice right off the bat. First thing to notice is if it's below the zero line, bearish. If it's above the zero line, bullish. That's this flat line right here. You can see the value right there, 0, and then here will be the value of the fast moving average. So that's kind of your quick little rule of thumb. The next is to pay attention. What I have is colored as the light color here is the fast moving average, and this what I have is the red is the slow moving average. I'm actually going to disable the histogram really quick, just because I really don't care about it. Which one's the histogram? Is it this one? I think so. And if that answers your question, I really don't pay attention to the histogram that much. I would rather use other volume tools, momentum tools, stuff like that to kind of gauge what that's really going to do. So I'm not even really to dive into it that much. So you can see here, below the zero line, bearish trend. Above the zero line, you kind of have somewhat of a bullish trend. Kind of flat here, but not bearish. There's a lot more to it than just below or above. So the next is you want there's two types of crosses. There's negative to positive cross. That is when the fast moving average is below the slow moving average and it crosses to be above it. That's negative to positive. So when these values are being talked about, you're kind of looking at it from the perspective of the fast moving average. So when the fast moving average is below the slow, it's negative. And when the fast moving average is above the slow, it's positive. So then you also have a positive to negative cross, which is considered bearish. So that's when the fast moving average is above and it crosses below the slow moving average. So the next thing you kind of want to look for is, so those are kind of your two things that you have working together. Those, you have one form of bearishness or bullishness, whether it's below or above the zero line. And then the next level of bearishness or bullishness is the type of cross that it is. So when you're looking at the MACD, what you really want to go for is you want to go for times in which these two things are agreeing with each other. So you want it to be double bearish or double bullish. So what I mean by that, when you have a positive to negative cross, it's much more effective when it's already below the zero line. So as you can see here, this small cross, I'll break into this a little bit more. As you can see here, this small cross causes a huge downtrend, right? And then here's this cross, and it only pops up a little bit. And then once again, this little cross there's a huge downtrend, right? And as to where, there's this cross, let's get a better example of the bullish one. As to where, here's a bullish cross, much bigger gap. Here's a tiny bullish cross, much bigger gap. Tiny bullish cross, much bigger gap. And this is because it's above the zero line. So that's what you kind of want. You want to have a double bearish or a double bullish. So when you want to short something, you want there to be a positive to negative cross below the zero line. That is just adding to the overall downtrend. And then when you're longing something, you're going to want the positive to negative cross, the negative to positive cross when it's above the zero line. As you can see here, when it's below the zero line, there's this tiny little pop when it crosses positively, as to where over here, there's this big pop. And I'll get into that a little bit more. So that's really what you want to go for. So if you're looking at something and you just want to eye it out really quick, if it's below the zero line, all right, cool, that's bearish. And if it's above the zero line, all right, perfect, that's bullish. Now, the next thing you want is, it's below the zero line, so I want to short a pop. So when it runs up a little bit like this, you're going to want to short it on this down cross. Just like here, when it pops up and runs up a little bit here, it's well below the zero line, so we want to short it on this down cross. So ideally, we'd be shorting up here, but that's just not when the cross happens. The cross happens, on this day here where the red dot is. So you'd be able to get it somewhere in this candlestick here. So you wouldn't get there, but somewhere in this candlestick. And then it would be able to trend all the way down here before it even has a cross. So you'd get to short the bulk of it. And then once again, these tiny crosses don't cause much of a pop at all, and followed by much bigger downfall. But once again, that's because it's below. Now there's reversals, and there's times where things get kind of weird. So in an ideal world, you'd be able to long this cross here, and you'd get this huge pop. But unfortunately, it was never really above the zero line. So those type of plays do kind of get away from you. And I'm just going to be real about that. That's just technical analysis. You can't always nail something perfectly. But what this does allow is it allows you to have times in which you're longing a stock without having to worry about it going into this crazy downtrend like this. So you get into these much safer swings. So now that it's above the zero line, let me zoom in a tiny bit more. So now that it's above the zero line here, now you can play these crosses. This one didn't really do much. Remember, these are day-long candles, though. So you will have time in the day. But if you're going for a swing, not obviously, there'd be kind of a choppy day. But then, you get into this cross, then you get the much bigger pop. And then, like I was saying before, when it comes down and when it's above the zero line and it retraces, it's leveling off. It's going sideways rather than breaking down to this. You're not becoming a bag holder when you're trading in here. When you're up here and it's dropping down to here, you're becoming a bag holder. So it's here, and you're having these really good pops even. And then once again, once it finally does kind of break down and it really does go into a new lower channel, if you pay attention here on, it eventually drifts. Like here at these levels, it was testing here, but it was above the zero line. Testing here, riding the zero line. So you kind of know it's getting choppy water. And then when it tests it a third time, it's testing below the zero line. So now we know, okay, shit, this time it actually might give out. It doesn't break on this one, but you do then get the positive to negative cross below the zero line. And once it's finally below the zero line, you get the breakdown. The support breaks and you get the breakdown. And then once again, you get into that same type of trend where you get the positive to negative crosses below the zero line. So here goes, it pops here, but we know it's below the zero line, so it can be short-lived. And sure enough, it pops. Sorry, I was here on this one. It pops here, makes a good run up. You could long this. I mean, that's really, 35 up to 38. That's not a bad trade, but you know that it's not going to keep going. You know to take profits soon, especially since this can be 3 times leveraged. I mean, that really could be a great trade. But like I said, you know that it's going to come short soon. And so then sure enough, then once again, you get the negative cross, the positive to negative cross. It's below the zero line. So boom, you just break down into this new lows. Here, once again, you could long this, sure, for sure, 27 all the way up to like 34. Oh my gosh, that's money. Times 3 leverage with UWTI. Excellent. But you know it's going to be short-lived, and sure enough, you get new lows. Now, ideally, you would want to be able to, I'm going to try to show you how to kind of get in on these type of huge runs, even though you don't have a cross. So obviously, if you were just waiting for the MACD cross from here to here, that's the safe way to go. You kind of do miss all this shit, and that sucks. You miss this big run up, but you're playing it safe. What you're essentially doing when you're missing this big run up is you're ensuring yourself that once you long it, look, it stays within this range. Even though it makes a little bit lower, it stays within range. Now it's uptrending. It's in a bullish trend. You're not longing it here and thinking, oh, it's going to make this huge new step up to here, all the way up to here, like it's starting to do now, but then it breaks down to a new low. So you miss it, but you're just playing it safe. And that's just kind of part of it. So you get it, but then like I said, you're ensuring, you can still get on this dip, you're ensuring that you're longing something in a bullish trend. And that's just what's way safer for these swing trades. So now the one time you can start longing it without the cross. Now, you got to remember, you didn't have the cross. So this isn't going to have as much security to it, but a lot of times you can play it relatively safe on both ends. But like I said, just be aware that you are breaking a rule here. So when you're playing it here, what to look for is once you get the fast moving average and the slow, not just the fast. Because here's the thing, look at this. The fast breaks the zero line a lot, and you don't go into a bullish trend. Breaks it here, no bullish trend. Breaks it here, no bullish trend. The fast moving average really isn't gonna be your best friend when talking long-term trend. So once you get all the data has now gone up above the zero line like this, that's when you can start kind of trying to play within here and longing inside of it and knowing that it's going into a bullish trend. And you might try playing something in here, but that would only be once all the data, once both the fast and the slow have then trended above the zero line. But like I said, there's going to be some other times where that might mislead you a little bit. So know that you're breaking a rule when you do that, but it is another way of longing something and trying to get into really big uptrends like this. And so then once again, I mean, on this dip, how do you know that this is just a temporary dip? It's well above the zero line, trends back up. It crosses, but it's well above the zero line, so it keeps going up. And then even this cross here, I mean, well above the zero line. Yeah, the fast dipped below, but the slow's still way up. And sure enough, here we are crossing. Even if it comes down again, which it looks like it's curling down to try to do so, it is facing major resistance here. I mean, that's a double top so far. But once again, it's still going to be above the zero line, so I would still call it a dip buy. And that's how you're going to want to read that going into the future. Right here, big, okay, this is going to cross, but I know that it's most likely going to test down here at support somewhere and then come back up rather than channeling down somewhere low. As to where here, it's well below the zero line, so it breaks the channel, goes down low. So that's how you kind of want to look for that. And then right here, once again, like I said, you do kind of get these little head fakes. And so if you were playing it safe, you might have missed this run up here. But you would have easily been able to get in on this dip, or if you had waited till all the data went back up above the zero line, then it went up. So those are the ways that you'd be looking for it for the most part. So just to reiterate, to wrap it up really quick, what you want to look for is you want to look for when it's below the zero line, that's bearish, above, that's bullish. A good time to long is a negative to positive cross above the zero line. That's when you want to long. When you want to short is when something is below the zero line and it has a positive to negative cross. That's a good time to short. And you can still play within those ranges. Yes, you can still play this pop here and this pop here on the cross, but just be very careful because you have to know that it's in a bearish trend. So while you still have things that go up in bearish trends, it still makes lower lows. And so just keep looking for that. Same thing with these uptrends. It's dipping, but don't get too happy on the DWTI. This is still trending well above the zero line. It's still in a bullish overall pattern. I'm going to flip to the chat room for questions really quick. How reliable is the dot as a signal? These dots are not buy and sell signals. These are not longing or shorting signals. All of these dots are cross confirmations. There are a lot of times when you're trading, and let me show you, when you're trading and you get something like this, where it looks like it crossed, but it never actually crosses. And there's times where it looks like it might dip and it doesn't. So what that dot is it's just there to tell you that it actually crossed the line, and it's not just hovering on it or just kind of above it. And it's just really nice. So you can just, once again, just quick glance, get your information you're looking for super quick. All right, back to the chat. The MACD file is, I believe it's in the pinned section of #3active trading. Okay, that's actually a good question. So if the slow moving average is below the zero line, but it's moving up, is that okay for an entry? Now, once again, that's just going to be something that's going to kind of, I can't say it's 100% safe. No, it's not 100% safe, but it is another it is a bullish indicator. So like I was saying before, when you're playing the cross and it's below the zero line, yes, you can hop into some temporary bullish action, and that might help you. That might help you when you want to long into some bullish. Like if it's in a bearish trend, but maybe you want to long it in that bearish trend. If it's sloping up, I will say yes, that is a bullish indicator. Well, not fully bullish because in a full bear trend, but yes, sloping up or moving up is bullish, just like sloping down is also additionally bearish. Good question. The fast moving average is okay. So the fast moving average visually is the yellowish green, and the slow is the red. Now, when identifying a fast versus slow, it's just what numbers you use. There's no like, oh, if it's under this number, it's fast. If it's under this, it's slow. I have 2 as my fast and 8 as my slow, but I believe standard is 12 and 26. So I mean, my slow is faster than their fast. All slow versus fast is fast is the small number and slow is the higher number. That's it. The actual value itself doesn't matter, just their relation to each other. The SMAs, yeah. I'm gonna do another lesson. The next lesson I do will most likely be on moving averages. And yeah, I highly recommend using this set of 5. I use the 13, which is the green, orange is 20, the red is 60, the light blue is 100, and the dark blue is 200. I love that set, and it looks clean. It doesn't clutter the chart like you think it would, having 5 moving averages. Yes, if you slow down the settings, it's more conservative, and I can't say reliable though. And I don't even know if it's more. It's a little more conservative because you're waiting for an overall trend, but you're cutting out a large bulk of the trend. The reason I have these very specific settings, and I've tried out, I can't tell you dozens and dozens of MACD combinations. The reason I have these specific settings is because when I follow all the rules that I've laid out with you guys, you can get into a trend change as early as possible. Now, a normal MACD, you're not going to get in at the bottom. You're not going to even really, sometimes you don't even get in at the middle. It honestly kind of enters you about 40% of the way up and then gets you out after it's dropped about 50% on the trend. So you get like maybe 60%, maybe I'm being mean, but it only gives you that tiny little bit. As to where what I like is if you follow all the rules, the settings allow for you to kind of get in after about 20% and get out after about a 20% drop too. So you're really getting much more meat of the trade rather than getting, a small 20% range. You're going to be getting more of like a 60% part of the overall swing. And that's kind of why I like those settings a little bit more. Cool. Are there any other questions? I think I covered everything. Know anything about Ikki clouds? Yeah, I did a whole entire seminar on the Ikkimoku clouds. There's a link that on our YouTube page. Yeah, just search traders on YouTube, and on our YouTube page we have one. Cool. So, any last question? Oh, multiple time frames. Oh, good to bring that up. I'll probably end up spending the last 9 minutes of our lesson on that. Okay, so what I like to look for is the train reaction confirmation. Is that an actual thing? I don't know. Is the Steph Curry pattern an actual thing? I don't know, but it freaking works. So that's why we do it. So what I like to look for is on your MACD, at the start of a trend change, you can literally kind of watch your time frames go off together, go off at the same time. So let's start here, for instance. So earlier over here at the start of this jump, if you were trying to long just for a 1 minute scalp, you would have entered in here, per se, because this is when it came above the zero line. This is when you would have entered. And then if you had gone up to the 5 minute mark, you would have seen that, okay, the 5 minute, while it's not above the zero line, there is still a cross coming in at the 5 minute. So I know that the 1 minute can chain react to the 5 minute. All right, that's still going to add to my loop up. Cool. And then you go up to the next time frame after the 5 minute crosses, and you'll be like, shit, it's still below the zero, but the 10 minute is about to cross. So then you could have that 10 minute cross. And then after it crosses, you hop up to the next time frame. And you're like, shit, okay, 15 is actually about on the zero line. We just had this positive cross. All right, this is chain reacting. It's going time frame to time frame. So here I am at the 15 minute watching it cross. And so now I can hop over to this 30 minute, and I can see here, oh shit, it's coming up. And now the 30 minutes is about to cross. I'm going to give this trade a little bit more time. And then as you go higher time frames, you can start to see, oh, this is well above the zero line. And it's already flattened. So it's no longer in a downtrend. It's flattened. So once the 30 crosses, I'll have the 1 hour on my side. And then what you look for is here. Perfect. Oh, no, not perfect. I lied. Here. So when you want to know when the trend is going to end, so here you still have it. You still have the negative to positive cross. So, okay, it can carry through the 2 hour. Oh, and shit, if the 2 hour works out for us, it can still carry into the 4 hour. Where can this trend end? Right here at the 1 day. We no longer can have a positive to negative cross. So that's when we know that our swing, or where we entered temporarily, can be coming to an end. And what's crazy is this, I can kind of just show you because it's happening live. Unfortunately, only up to the 15 minute mark. But on all of these big swings, it's hard to just kind of show the time frame per se. But on all these big, oh wait, actually, can I make this? Let's do this. So here's where the trend change. Okay, I'll try to do this. This is difficult. I've never tried to go back in time to kind of look at it like that before. Let's find it. So what you do is, I'm gonna try to find a closer one. I don't think I can go back that far in the 1 minute. Don't worry, because you can do this for, you're gonna see this happen. It totally happens too, which is nice for like 425. Yeah, that should be on my 1 minute. There we go. Hang on. Did it not? Okay, this is such a pain in the ass. Okay, I'm going to start at the 15 minute then. So starting at the 15 minute, you'll get these cross. So here it is. At the 15 minute, we had the positive negative cross. We didn't quite get, we couldn't get it above. It wasn't above yet. So we might not have longed here. But then it crossed here, and then it had another, you can see this green dot, negative to positive cross above the zero line. So we could have longed on the 15 minute, and then we would have seen the chain reaction go off. Try to find the 30. And so then right here on the 30, we would have said, actually, you would have been completely safe, because right here on the 30 is when you would have actually kind of thought it can end, to be honest. So that's what your sign here on the 30 would have been. Like, okay, it can't have a positive to negative cross. So it can come to an end. But until it crosses, it's not over. So it's still going. Got 1 hour. 30-minute crosses. Oh, there it is. Jesus. And then, so once again, once that had crossed, you would have seen once again, the positive to negative cross there. It had already happened, but it's trending up. It's there moving above the zero line. You go to the 4 hour. Here it is. The 4 hour is actually clear as day. It's all above the zero line. And it kind of just chain reacts. Like I said, it's tough to show just going back in time, but it's easy to kind of see on the example happening right now today, how the 5 went, then you had the 10, then you just had the 15, and then you just kind of look for the 30. And then when you want this to end is on starting at the 1 minute is choppy. So what I try to do is you might want to look at the 5-minute for the cross, or you can look for the 1-minute trend change. And here is how you look for the 1-minute trend change. So when you're going into the 1-minute, when you're looking for your positive to negative crosses, you just want to wait for it to go below the 0 line, obviously. It can get choppy. And then you also want to look for when that happens with a lower low. So right here, we have a higher low with each positive cross. So that cross happens, still higher. We're not breaking the lows really. So until you kind of start breaking down on the lows, that's when you would want to do it. But like I said, the 1-minute, that's a really choppy time frame. So for this overall one, you'd want to wait for, just look for the 5-minute to cross. And that's when you'd want to get out of, a short-term trade. But you could also just kind of hold out, wait for this 30 minutes to try to cross, and you'd be good to go. Yes, positive is green and the negative is no. Sorry, the fast is green and the slow is red. Positive is when the fast moving average is above the slow moving average, and negative is when the fast moving average is below the slow moving average. Get out of here, Tosh. Yeah, exactly, stuff and fluff. The more crosses that you can see happen and the more reactions that you can see going on, the more you can kind of see the overall outlook of where your trade is going. So if you're at the 5-minute and the 5-minute can have a negative to positive and the 15 can have negative to positive, but the 30-minute can't, then you're going to be like, okay, this trade can kind of start to come to an end around when the 30-minute time frame would be playing out. But if that doesn't happen until the 2-hour or the 4-hour of the day, then it can really keep swinging all the way into that time frame. It's not going to really come to an end until a time frame completely disagrees with you. And even sometimes if a time frame completely disagrees with you at the beginning, after the 5, 15, 30, 1-hour cross, sometimes like that 4-hour all of a sudden has started to drift above the 0 line and you're in a bullish trend. That's about it, guys. We're about to run out of time. I hope this was helpful. And yeah, I will see you guys in the chat. Ask me any questions you guys want in #3 day trading. And oh shoot, I forgot to record. Just kidding. It's fine. All right. See you guys.